All right, what's up everybody? This is Scott here again with my next live trading video. Today is Wednesday, April 27th, and two things I want to do in this video here. Number one, I want to go over the two earnings trades I've made so far this week. One was yesterday in Spotify, and the first one was on Monday, I believe, in UPS. Both those trades worked out beautifully, so again, I want to go over them so you can see exactly how everything worked. And then secondly, in this video, I'm going to place a brand new trade in, if we come to the charts real quick, GLD, which is gold. So I personally am very bullish in a variety of metals right now, gold included. I also have bullish positions on currently in aluminum, copper, and steel as well through individual companies. So again, to add to my metal portfolio here, I want to place a brand new trade on gold as well. And the main reason why I am so bullish on these kinds of metals is because of inflation, right? Inflation is pretty much getting out of control at this point. We're hitting 40-year highs, and products like steel, copper, gold, etc. have increased in price dramatically. And that's partially because metals like gold are considered as inflation hedges. So oftentimes in the past, when inflation has increased significantly, you'll see a lot of demand for things like gold and silver. And so ultimately, given that I personally think that inflation is here to stay for quite some time, that's why I'm going to place another bullish trade here on gold. Now, as always, before we dive in though, in case you are brand new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Okay, so first off here, let's go over the two earnings trades I made this week so far, and we'll begin first with my UPS earnings trade that I made on Monday. And so as you can see on the charts down here with these small icons, this was their earnings announcement, which happened on Tuesday pre-market, and you can see they beat expectations by a little bit. And so just to recap on the exact trade I made here, let's come back to the monitor tab very briefly, and we'll go to my account statement. And so what you're seeing down here, these are all the trades that I've made in the past 5 days, basically for this past week. And so again, on Monday here, which was April 25th, I placed my earnings trade on UPS where I sold a short strangle with a 210 strike call option and a 165 strike put option. So again, the whole point of this trade was to sell options super far away from the current trading price of UPS and simply play for a large contraction in the implied volatility for the stock. Right? Because once those earnings figures become public, and if the stock moves less than what is expected, you're pretty much guaranteed to see that huge collapse in implied volatility and therefore a huge collapse in option prices. And that's exactly what you can see here with this closing trade on my UPS position. I closed this one the morning after on April 26th, that Tuesday morning, and I was able to buy back my entire position for a debit of only $249, less than half price here. Right, so literally in just a few hours, once those earnings figures became public, because UPS only moved by a few dollars, well within the expected range, all the prices of the option contracts on UPS collapsed. And I can show you that in a visual sense as well if we come back to the charts real quick. And then we'll come down here and take a look at the implied volatility chart for UPS. So as I showed you in that previous video on Monday where I placed that trade, leading into the announcement, you almost always see a very large expansion of implied volatility. And then, like I said, once that earnings announcement happens, you almost always see a very large crush in the implied volatility. And again, the smaller the move of the stock on that earnings announcement, typically the larger the crush will be. And so if I zoom in a bit here on this chart, and you can see with this candle right here, as of Monday's close on April 25th, UPS closed right around $190 per share. And then the following morning on Tuesday, UPS opened at around $186 per share, so it dropped only by about $4 off that earnings announcement. Now this stock did continue to move lower over the course of the day, but again, I closed this trade pretty much 5 or 10 minutes right after the market opened. And I believe the expected move for this stock off that announcement was around $17 or $18. So again, if UPS only moved by 4 or 5, or even if you look at the final closing price of the day, where UPS closed on Tuesday at around $183 per share, that's still only a drop from the previous close of about $7. So 7 is obviously way, way less than an expected move of about $17 or $18, and that's why, again, we saw a huge contraction of the implied volatility. And then the exact same thing played out again for my Spotify earnings trade as well. And Spotify reported earnings this morning, and we'll go ahead and zoom in a bit on this chart as well. Now, Spotify definitely moved a bit more. It's currently down by almost $13, but still within the expected move. For Spotify here, the expected move was about $17 or $18 as well. So once more, because the stock moved less than what's expected, we saw a very nice contraction of the implied volatility just in the first few hours this morning. And there's definitely still a whole lot more room for the contraction to continue further. So ultimately, once more, if we come back to the monitor tab and take a look at my two Spotify orders, as you can see yesterday on April 26th, Tuesday, right before the market closed, as you can see here, this was my opening order to place that earnings trade, in which case I sold another short strangle with a 142 strike call and an 85 strike put. Again, making sure I sold my contracts very, very far away from the current trading price of the stock, just to accommodate a possible large move in the stock price, right? Sometimes the stock will move more than what's expected, but also because the implied volatility was so high, I could sell options so far away and still collect a very, very nice credit of $510. So ultimately, I placed this trade on Tuesday right before the market closed, and then on Wednesday this morning, once Spotify announced those earnings, I was then able to buy back both contracts for a much smaller debit of only $330. And then also, just as a side note here, you can see two more orders in Marvel and UAL. This one here was an opening order. I sold two put options on Marvel Semiconductor just as a brand new trade. Wanted to get a bit bullish on some more tech stocks here, given the recent sell-off. And then also I closed my UAL short call options for a nice profit there. So anyways, those are my two very textbook earnings trades. And then next up in this video, let's come back to the charts and we'll go back to GLD. And then in terms of a little bit of charting analysis, let's go ahead and zoom in a bit here. And so I have been waiting for a little while here to see a sell-off in gold. So at that point, I can use that as an opportunity to get in and get long on this product here. So specifically, I really wanted to see if GLD could come down to perhaps around this major support level, right? As you can see right there, we have a very large gap, which GLD did close a couple times here, but ultimately it has bounced off that point. It has not gone lower, at least as of yet. And that's definitely a bullish sign. And then also back here, looks like at the end of November of 2021, initially gold did top out right around this point, right around $175 per share. So back during this time, this price point was acting as resistance, but again, over here in more current times, that price point has since flipped over to support. Now, ultimately, because I do intend to be in this position for quite some time, perhaps well over a year or even more, then technical analysis and all that does not matter a whole lot, but still, if I have the chance to possibly wait a little bit and get into this product at a more favorable price, then I'm certainly going to try and do that. So again, right now, I do think GLD is at a very favorable price to get in on the long side. So that's what I'm going to do right now. And then in terms of the implied volatility for GLD, with the exception of this time right here when things got a bit crazy, for the most part, GLD is a very quiet product, not very volatile. So currently the IV is just under 20%. That's very, very low. And so because of that, that means the options on GLD most of the time are pretty darn cheap. So that's why I'm going forward with a poor man's covered call here by buying a far in the money long call option, because that's not going to be too expensive. There's not going to be a lot of extrinsic value with that contract. So I don't mind paying for that. And then also with gold typically being a very slow moving product, using a long call option should add a bit of leverage to this overall position instead of just buying shares of stock outright or using the wheel strategy, things like that. So again, that call option should give me a little bit of added upside if GLD does continue to rise even further. And the reason for that, if we now come over to the trade tab and take a look at the option chain for GLD, and for this trade, I'm going to go super far out, probably all the way to January 19th of 2024, about 2 full years in the future. So we'll unfold that tab and scroll down to these far in the money call options. And then in particular, I'm probably going to sell this call option right here. This is the 150 strike with a 74 delta. So typically when I do trade the poor man's cover call, I choose around the 75 to 80 delta contracts. And the reason why this is going to give me some added leverage is because if GLD does start to move higher, right? Let's say that GLD increases in price by $1, then the price of this call option is going to increase by about $74. And then also the delta will increase as well. It might go to 75 or 76. And then again, if GLD increases in price by $1, then the price of this call option will increase by $75 or $76. And once more, the delta of the contract will increase. So basically, the higher that GLD climbs, the greater and greater profits I will make on this call option here. And that's basically what leverage is. I'm essentially generating much larger returns over time than if I simply bought, let's say, 74 shares of GLD outright and just held onto those shares for the long term. right? 74 shares of GLD stock will only ever provide a profit of $74 for every $1 increase in the price of GLD. But as I just explained with this call option here, the profit I would make for every $1 increase in GLD will get larger and larger and larger as GLD does increase in price. That's the main difference. So now I'll go ahead and click on the asking price of this call option to bring up a buy order down below. For right now, I'm just going to buy one contract, 150 strike call option, and I'll try and do so for a debit of around, let's say, $36.20 on a per share basis. So in total, that's $3,620. So now I'll go to confirm and send. And obviously the buying power effect for this trade is that same amount, $3,620. So I'll go to send. And there we go, just got filled at exactly $36.20. Awesome. And so that's the first step of putting on the poor man's cover call, right? That long call option is going to act basically as a more leveraged form of long shares of stock. And so the second step now is to sell a shorter term call option to collect some additional premium. And so for that contract, let's come back to the option chain here. And we'll still go into the May monthly cycle with 23 days left to go. We'll unfold that tab here and scroll down to the now out of the money options. And so as you can see here, the prices of these call options are definitely not very expensive, even the ones that are right at the money. And again, that's because the implied volatility for GLD is typically very low. So for the most part, even though I'm still going to go ahead and sell an option here to collect some premium, it's obviously not going to be very much. So mainly this position is going to be a just straight up long stock position or leverage long stock position on gold. Now I do have to be a bit careful though with how I choose my short call strike, because as I've shown in previous live trading videos, with the poor man's cover call, if you do choose your short call strike to be too low, and if you do get assigned on that call option and therefore have to exercise your long call early, you might find that overall you lost money on the entire position. And that's a very bad thing because this is meant to be a bullish strategy. So if GLD does go up and if perhaps I do get assigned on my short call, I do want to walk away having made some amount of money. So now if I go ahead and pull up the calculator real quick here, and so because for that long call option, I paid a total debit of $3,620, that means if I do get assigned on whatever call option I do decide to sell, I want to make sure the final outcome of that entire position is equal to a profit of $3,620, right? Because if I make that exact amount through the assignment process, and then I also lose that amount because that's what I paid for the call option, then the net effect is I don't make or lose any money. So basically, what I want to calculate here is the lowest strike I can possibly sell my short call option at. And to do that, I simply take this number and divide it by 100 to get it on a per share basis. And then I add this to my long call strike of 150. And that gives me 186.2. So basically, I want to pick my short call strike to be somewhere around $186. And so for this trade here, I may as well go ahead and pick exactly 186. Right? Because now if GLD has a monstrous run in the next couple weeks here, and let's say by the May expiration date, GLD is above 186 and I get assigned on my call option here, in that case, I'll have to sell 100 shares of GLD at my strike price of 186. And before I can sell those shares, I'll have to exercise my long call option early to buy them at the lower price of 150, and then I can turn around and sell them to honor my obligations on this short call option there. And in which case, if we bring back the calculator one last time, if all that did play out and I exercised my long call option early and bought the shares at a price of 150 per share, and then once more to honor my assignment obligations, I turned around and sold those shares at the strike price for my short call at a price of 186 per share, that's a profit of $36 per share times 100, which makes for a full profit of $3,600. And then on top of that, I do still get to keep the premium for selling the short-term call option in the first place, which is right around $60 or so. So we add 60, and that brings my full profit to $3,660, which finally, if we then subtract the initial debit I paid to buy that long call option of $3,620, that still leaves me with an overall net profit of only $40, but still a profit nonetheless. And then as time passes and I continue to sell these call options and collect more and more credit, I can use that credit to reduce my cost basis on that long call option, which will then allow me to, over time, sell short-term calls with a lower and lower strike and collect more and more premium. So now with that said, let's go ahead and sell this contract. We'll go ahead and click on the bid price now. And that brings up a sell order down below. Just going to sell one contract to match my one long contract, 186 strike call option, and we'll try and do so for a credit of exactly 60 bucks. Then go to confirm and send. And notice how the buying power effect for this trade is exactly 0 because my long call option in the 2024 cycle can be used to cover any losses on this short call. So again, that's why this part of the trade requires no additional capital. So that's great. And then we'll go to send. And there we go. Just got filled at 58 actually. Had to come down by 2 pennies there. And there we go. So now I'm officially in this trade for the long term. And every expiration cycle, I'm just going to keep selling more and more call options, again, to reduce my cost basis on that long call. And hopefully in the long term, I can actually make a very nice profit on GLD here. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.